This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Getting into the week, it's a Tuesday morning, lovely Tuesday morning, I might add, here in Mumbai. I'm Prashant, with me my colleague Sonia and Nigel. Guys, hi. Morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, it is indeed a lovely Tuesday morning. We still have that good weather so far. Although there was one day in the middle it got really hot, so I was thinking, okay, is it the end of this beautiful stretch of nippy weather? But anyway, it's been good so far. For the market, not so much. The weather has gotten a bit volatile because we've been coming off the day's highs for the last couple of days. Let's see which way things go. Long day ahead.
Well, that's right. And overnight things as well, a little bit sticky, I think, so with the strength that we saw on the dollar index as well as the yields. And early this morning, I think a lot of your bandwidth went in analyzing HDFC Bank, which may not be the case for the day. So let's get straight to the action.
What a morning. We won't tell the full story. No. But in any case, let's just quickly tell you and get on with the market in terms of what you need to know. And we'll have to sort of rewind the clock back and look at the last 3 days, really. And I'll tell you why. The graph will come up. The market has been finding it difficult to sustain at high levels. And that graph makes it absolutely clear. So, for example, on the day of the budget, the market, it was a small range. But even then, the market came up for 126 points off the day's high. The next day, about 273 points. That was that Friday. And of course, yesterday, it was a full 200 points off the day's high. It's not sustaining. I mean, it's at high levels. And by the way, on Friday, we made a small 2-point higher high, a new all-time high, which is by 2 points. And then, of course, there was that massive pullback, which we saw. So there is selling pressure and there is, nervousness, and kind of people are jumpy around these elevated levels, and that's clearly showing through. Now, that's the backdrop, right? So remember that. Now, because we are finding it difficult to sustain and maintain these intraday highs, the question is, are we in for a bit of a deeper pullback? Now, if you look at the global, if you ask the global scene that question, the answer perhaps would be maybe yes. And I'll tell you why. Because not just because of the overnight action, the S&P was down 1/3%, which is not much. The Russell, in any case, has been this huge underperformer. It was down another 1.5%. But the fact that data in the US is actually coming in stronger and stronger. You know, the thing is, the narrative which has been set for a while is that data will be strong for a while, and then the base effect will kick in. Data will eventually come off a little bit, and it's just a question of when the Fed will cut rates, right? But if something else happens, which is the unexpected thing, which is that data continues to come in much higher than expectations, then what? Then, I mean, a lot of the thesis will go out of the window, which is that cuts are coming. It's a matter of when. So, in that light, the ISM services index came through. It beat expectations on all subcomponents: prices paid, wages, orders, everything. I mean, the ISM was a complete beat. And this comes after the jobs report, which also across all parameters was a big beat as well. There was a comment from one of the Fed members yesterday, and this is what he said. He said the neutral rate may have increased. Now, what is commonly assumed is that the neutral rate is around 2.25% to 2.5%. But he said at which point the Fed basically is comfortable. And he said policy is not tight enough. So it's the first of those comments. Otherwise, I mean, there has been really consensus that rates need to come down. It's a question of when. Bond yields saw a sharp jump. The 10-year went up 14 basis points. And we're now at about 4.16%. We were under 4% briefly last week. Dollar index, it's also strengthened, taken strength. 104.5 is where we're at. And oil prices are back to about $78 a barrel as well. So, I mean, the picture is not all that great as we come back this morning. Now, the Nifty, just to come back to the levels, etc., you now need to, it's clear, market's not sustaining at high levels, and if it goes up, we'll tackle levels, etc. But what you need to focus on is protecting downsides. And I think for the Nifty, the budget day low, which is 21,658, that remains an important area. I mean, I think if it breaks, I think it'll signal more pressure up ahead, more turbulence up ahead. The 20-day, by the way, is also around the budget day lows. That stands at 21,646, so roughly around the same. But lower than that, then you're looking at, if that goes, the 40-day exponential moving average comes in at about 21,364. The Nifty Bank, I think it's been weak. It never participated yesterday. For example, the Nifty at one point yesterday was up 100 points. The Bank Nifty was flat and it sold off along with the Nifty. So it's weak. It can retest the recent lows, which is 44,429. And below that, I mean, the Nifty can take to about 43,129. The 20-day is the resistance for the Nifty Bank. But I mean, I think we're talking downsides and protecting downsides rather than looking at upsides right now. I mean, the thing to do is, of course, not be leveraged at all and be very careful if you're diving in to make short-term gains, right? I mean, and it's been easy. It's been so seemingly easy, and that's how people get sucked in because money is being made so fast. You buy something, 2 days you're up 20, 30%. So why not? But I think as the last 3 days have shown, there is a little bit of nervousness, and swings then can be very, very sharp. If you buy something which is up 3x, you can lose 20, 25% just like that. So one should be mindful of that when you enter markets at this point in time, especially since the market is telling you that it is not comfortable sustaining very high. 14 points higher on the GIFT Nifty. Sonia.
Absolutely. I think the volatility is something that, is not working well, right, for the market in the last 3-4 days. So the Nifty has been coming off from the day's highs for, I think, 4 consecutive days now. So that's not a good sign, definitely. The Dow was under pressure yesterday, so that's definitely going to put some stress on the market. And as I said, the Nifty fell about 200 points from the day's highs yesterday. So this is this pressure in late trade that the market has been staring at for a couple of days. Now, I'm watching out for a couple of levels. The 20-day moving average is at 21,647 thereabouts. That's perhaps the next line in the sand to watch on the downside. So that's going to be a crucial, indicator for me. Domestic institutions sold in the cash markets in a big way yesterday. So almost 1,200 crores of money was pulled out of the cash markets. That's not a good sign either. The next big event to watch is the RBI policy. That happens on the 8th of February. Although the Reserve Bank is expected to hold rates for the 6th consecutive time this time around, any indication of monetary policy loosening is something that the street will watch out for very, very closely. So that's the next big trigger for the market. In terms of earnings, you had a decent set of earnings from the likes of Bharti Airtel, Ashok Leyland. There was no blowout performance either way, especially from the large cap names. But one pocket that I'm looking out for very closely is the PSU banks, because yesterday, despite seeing a rally in the PSU banks through the course of the day, the delivery-based buying was on the lower side. So SBI, Bank of Baroda, Punjab National Bank, there was barely any delivery-based buying. It could be just speculative action, just trading action. So that's something, to keep on your radar. Be a bit cautious over there. In fact, even if you look at the absolute value in Bank of Baroda, Punjab National Bank, there was not even 100, 200 crores of delivery-based buying. So that's just one pocket that perhaps has some speculative action. But other than that, the big event to watch, of course, as I said, will be on the 8th of February. The GIFT Nifty for now is just sort of ambling along.
Well, Sonia, since there was so much of focus on HDFC Bank, I said, let's just do a quick hygiene check and tell you what does HDFC Bank in terms of weightage, both on the Nifty as well as on the Nifty Bank. And that should come up for you on the screen. Remember, it's the largest constituent in terms of weightage. Moving to the key levels, since the Nifty Bank has been a relative underperformer in the last few days, well, the near-term number that you're looking at is the 20 DMA. That's the important mark that you're looking at on the upside. On the downside, at the 100 DMA. So currently, we're in the middle of both those two marks. The reference level you want on the downside is around the 100 DMA, and you don't want it to break that decisively. What did the FIs do yesterday? Well, they added close to 11,000 long contracts. They covered some mild shorts as well. And that's what's brought the short positioning down to around 64%. Just a few sessions ago, the short positioning was close to around 80%. So it's come down in a large manner. From around 80%, it's come down to around 64% odd. And the net short contracts have come down by 45,000 short contracts. Earlier they were net short to the tune of around 1,08,000 contracts, the FIs. Now that's come down to around 64,000 odd. So that's telling you that there has been some short covering that's played out there as well. Well, in terms of, levels that we're looking at, yesterday we had some aggressive writing that came at around the 21,900 call and the 22,000 call. And that brings me to the level. Since we are seeing 22,000 call has the highest open interest, the premium is roughly around 100 rupees yesterday at the start of trade. That becomes a resistance zone, the recent high. On the downside, you don't want the 20 DMA to break because that's your first reference point on the downside. And the kind of action, the kind of put writing that we've seen, I don't expect the 21,500 mark to get broken. That's the level, crucial level, and that's the line in the sand that I'm looking at. So that's about the levels that I'm looking at. In terms of the sector of the day, maybe in the next few sessions or maybe today as well, the sugar stocks yesterday, they saw a good amount of up move. Some of them came off the high point of the day, but there was a fair bit of delivery-based buying as well. So in terms of a sector to watch, I'll say keep an eye out on some of these sugar stocks. Some of the smaller names as well are in there, but but the delivery-based buying was quite high in comparison to the 10-day average. So let's see how this goes. But I think the Nifty is in a bit of a range for the near term. 21,500 on the downside. On the upside, 22,100 is what we're looking at, guys.
All right. Thanks a lot for that, Nigel. Well, just get back here now so that we can kickstart this show, right? Lots happening in the next 2.5 hours. On the equities front, we have a comment coming in from Harold Vanderland of HSBC, who says that funds are underweight on mainland China, but some in Europe are cautiously building up a small exposure. He says a stronger yen adds to headwinds for Japan equities, but optimism is high for corporate governance improvements. He also says that India and Indonesia remain everyone's favorites, though few are looking at building further in India. He adds, large banks provide better value over consumer names. In the longer run, Harold says, ongoing improvements in infrastructure could put pressure on the high corporate margin.
Well, let's get you some money market views now. Abhishek Goenka of IFA Global, who says that a rupee is strengthened to 82.83 to a dollar on Friday, but soon gave up all gains. Overall dollar strength emerged after US January labor data came in much better than expected. He says Fed Chair Powell said that the Fed is unlikely to wait beyond March to cut interest rates. He adds US yields have moved higher. US dollar is strengthened. Meanwhile, he adds the USD INR continues to exhibit extremely low beta to the broad dollar implied volatility. Has also plummeted to record lows. He continues to expect the range for the USD INR to be between 82.7 to 83.5 over the medium term and believes if an eventual break happens, it will most likely happen on the downside.
Okay, and on the bonds, Vishal Goenka of IndiaBonds.com says that bond yields were higher yesterday following cues from the US, where employment data continues to be strong and any likely rate cuts are pushed to June. He says the RBI policy on the 8th of Feb, where he expects the repo rate to be unchanged and a status quo on liquidity. The yields could trend higher in the week, and he expects the 10-year benchmark bond yield to trade in a range of 7.08 to 7.13% today.